Section 5:2 Understanding the Volatility Index, VIX, 5.2 Risk Assessment and Position Sizing. Risk assessment and position sizing are crucial factors to consider when incorporating the VIX into investment decisions. Here's an analysis of their importance. Risk assessment. Risk assessment involves evaluating the potential risks and uncertainties associated with investment decisions. When incorporating the VIX, which reflects market volatility and risk sentiment, it becomes essential to assess the potential impact of volatility on the investment portfolio. Understanding the risks involved allows investors to make informed decisions and implement appropriate risk management strategies. Volatility risk. The VIX is a measure of implied volatility, and its level can fluctuate significantly. Higher volatility levels indicate greater uncertainty and potential market downturns, which can adversely affect investment positions. By assessing volatility risk, investors can identify potential vulnerabilities in their portfolios and take appropriate measures to mitigate the impact of volatility. Correlation risk. It's important to consider the correlation between the VIX and the underlying assets in the portfolio. While the VIX is often considered a measure of overall market volatility, the correlation between the VIX and specific assets or sectors may vary. Understanding the historical and potential correlation patterns helps in assessing the potential impact of VIX movements on specific investments. Contango or backwardation. VIX futures, which are often used for hedging or speculating on volatility, can be subject to contango or backwardation. Contango refers to a situation where longer-term VIX futures contracts trade at a premium to shorter-term contracts, while backwardation refers to the opposite. Contango can lead to roll costs and potential value erosion in VIX futures positions over time. Assessing the contango/backwardation dynamics is important when incorporating VIX futures into investment decisions. Position sizing. Position sizing refers to determining the appropriate allocation of capital to different investment positions. When incorporating the VIX, position sizing becomes crucial to manage risk effectively and optimize potential returns. Diversification. Proper position sizing allows for diversification across different assets, including VIX-related instruments. Diversifying the allocation helps spread risk and reduces exposure to any single investment. It's important to consider the proportion of the portfolio allocated to VIX-related instruments relative to other holdings. Risk tolerance. Position sizing should align with an investor's risk tolerance. The VIX and VIX-related instruments can be volatile, and position sizing should consider an individual's risk appetite and capacity to withstand potential losses. Investors with a lower risk tolerance may choose to allocate a smaller portion of their portfolio to VIX-related instruments. Portfolio objectives. Position sizing should align with the overall investment objectives and goals of the portfolio. Investors may have different strategies, such as long-term growth, income generation, or capital preservation. The allocation to VIX-related instruments should be consistent with the intended purpose, risk profile, and time horizon of the portfolio. Monitoring and adjustments. Regular monitoring of positions and their impact on the portfolio is essential. As market conditions and volatility levels change, adjustments to position sizes may be necessary. Continuously reassessing the position sizes in VIX-related instruments helps maintain an optimal risk-reward balance. Incorporating the VIX into investment decisions requires a comprehensive risk assessment and thoughtful position sizing. By understanding the potential risks associated with volatility and appropriately sizing positions, investors can manage risk effectively and make informed investment choices. Consulting with a financial advisor or risk management specialist can provide valuable insights and assistance in assessing risk and optimizing position sizes. Volatility has a significant impact on portfolio risk, and implementing effective risk management techniques is crucial to protect portfolios and achieve long-term investment objectives. Here's an analysis of the impact of volatility on portfolio risk and the importance of risk management techniques. Impact of volatility on portfolio risk. Market risk. Volatility is a key component of market risk. Higher volatility levels are associated with greater uncertainty and potential market downturns. When volatility increases, asset prices tend to be more volatile, leading to larger price swings and potentially larger losses in the portfolio. Therefore, higher volatility increases the overall risk of the portfolio. Asset correlations. Volatility can also impact the correlations among different assets in the portfolio. During periods of high volatility, correlations between assets may increase, reducing the benefits of diversification. This can result in a portfolio that is more vulnerable to systemic risks and market-wide downturns. Understanding and monitoring correlations is important for effective risk management. Importance of risk management techniques. Diversification. Diversification is a fundamental risk management technique that involves spreading investments across different asset classes, sectors, and regions. By diversifying, investors can reduce exposure to any single asset or market, lowering the potential impact of volatility on the portfolio. Diversification helps to manage unsystematic risks and improve the risk-reward profile of the portfolio. Asset allocation. Asset allocation is another key risk management technique that involves determining the appropriate mix of asset classes in the portfolio. A well-diversified portfolio with a strategic asset allocation can help balance risk and return objectives. By considering factors such as risk tolerance, investment goals, and time horizon, investors can allocate assets in a manner that aligns with their risk preferences and long-term objectives. Stop-loss orders. Stop-loss orders are orders placed with a broker to sell a security if it reaches a specific price. Stop-loss orders can be used to limit potential losses and protect capital during periods of heightened volatility. By setting predefined exit points, investors can mitigate the impact of adverse price movements and implement a disciplined approach to risk management. Hedging strategies. Hedging involves using derivative instruments or alternative investments to offset potential losses in the portfolio. Options, futures, and other hedging techniques can be employed to protect against specific risks, such as market downturns or increased volatility. Strategies like protective puts, collars, or VIX derivatives can be used as hedging tools to manage portfolio risk. Risk assessment and monitoring. Regular risk assessment and monitoring are essential for effective risk management. This involves evaluating the potential risks in the portfolio, assessing the impact of volatility and market conditions, and adjusting positions as needed. Regular portfolio reviews and stress testing can help identify vulnerabilities and make informed decisions to mitigate risk. Risk-adjusted performance. Evaluating portfolio performance using risk-adjusted measures, such as the Sharpe ratio or the Sortino ratio, provides insights into how well the portfolio has performed relative to the amount of risk taken. A focus on risk-adjusted performance helps in assessing the efficiency of the portfolio and identifying opportunities for improvement. Implementing risk management techniques is essential for navigating market volatility and protecting portfolios from significant losses. By diversifying, strategically allocating assets, setting stop-loss orders, employing hedging strategies, and regularly monitoring risk, investors can effectively manage volatility and align their portfolios with their risk tolerance and investment objectives. Working with a financial advisor or risk management specialist can provide valuable guidance and expertise in implementing appropriate risk management techniques.